Chapter 9. Describe debt securities and the markets in which they are issued. Debt securities are issued in exchange for borrowed cash. A formal agreement or contract signed between borrower and lender is called a note. Bond is a type of note, which breaks down a large debt into smaller chunks. In return for the borrowed cash, the borrower typically makes periodic interest payments and repays the face or par value at maturity. The definition of notes or bonds. Different names for debt instruments that require borrowers to pay the lender the face value and usually to make periodic interest payments. Face, par value, or principal. The amount of money the borrower agrees to repay at maturity. Maturity date. The date on which the borrower agrees to pay the creditor the face or par value. Stated coupon or contract rate. The rate of interest paid on the face or par value. The borrower pays the interest to the creditor each period until maturity. Market yield rate. The market rate of interest demanded by creditors is a function of economic factors and the creditworthiness of the borrower. Secured bonds. Secured debt provides collateral such as real estate or another asset for the lender. That is, the borrower fails to make the payments required by the debt, the lender can repossess the collateral. Unsecured or debenture bonds. Debt that does not have a collateral is unsecured. Unsecured bonds typically are called debenture bonds. Junk bonds. Junk bonds are unsecured bonds that are also very risky and therefore pay a high rate of interest to compensate the lender for an added risk. Callable bonds. Callable bonds give the borrower the option to pay off the debt prior to maturity. Borrowers will typically exercise this option when the interest being paid on the debt is substantially greater than the current market rate or interest. Convertible bonds. Convertible bonds give the lender the option to convert the bond into other securities, typically shares of the bonds or shares of the common stock. Lenders will typically exercise this option when the value of the shares of common stock is more attractive than the interest and principal payments supplied by the debt instrument. The relationships between stated interest rate and yield. Bonds sold at premium or above par have a greater stated rate than the yield, have a greater interest rate or interest paid than interest expense. Par is when the yield equals stated rate. Interest expense is equal to the interest rate or interest paid. Discount or below par is when yield is greater than the stated rate. Interest expense is greater than the interest paid. Account for the issuance of long-term debt. The issue price of long-term debt is typically quoted as a percentage of face value. Example, blank. At time of issuance, the borrower records the face value of the debt in bonds payable or notes payable. Any amount of cash received over the face value is credited to premium. Any amount of cash received under the face value is debited to a discount. The bonds payable or notes payable is netted with a premium or discount when reported on the balance sheet. Analyze a company's long-term solvency using information related to long-term liabilities. Although long-term creditors are concerned with the company's short-term liquidity, they are primarily concerned with its long-term solvency. As such, long-term creditors focus on ratios that incorporate long-term debt and interest expense payments. These are ratios. Debt to equity equals total liabilities divided by total equity. Debt to total assets equals total liabilities divided by total assets. Long-term debt to equity equals long-term debt divided by total equity times interest earned accrual basis equals operating income divided by interest expense times interest earned cash basis equals cash flow from operations plus taxes paid plus interest paid divided by interest payments. Chapter 10. Stockholders' equity, which also is called equity, represents the owner's claims against the assets of a corporation after all liabilities have been deducted. There are various elements of equity, and the stockholders' equity section of the balance sheet clearly classifies these elements according to their source. 1. Contributed capital, split between preferred and common stock and the associated paid-in capital in excess of par. 2. Retained earnings or deficit. 3. Accumulated other comprehensive income. And 4. Treasury stock. Shares authorized, issued, and outstanding. The maximum number of shares the business may issue in each class of stock is referred to as the number of authorized shares. The number of shares actually sold to stockholders is the number of issued shares. The number of issued shares actually in the hands of stockholders are outstanding shares. When firms reacquire their own stock, the reacquired shares are not considered to be outstanding. Distinguish between common and preferred stock and describe their use in raising capital. The primary rights for owners of common stock are: number 1, voting in the election of the board of directors. Number 2, sharing in the profits and dividends of the company. Number 3, keeping the same percentage of ownership if new stock is issued, otherwise called preemptive right. And 4, sharing in the assets in liquidation in proportion to their holdings. This is referred to as residual claim because common stockholders are only paid after all creditors and preferred stockholders are paid in full. Corporations sell both common stock and preferred stock to raise capital. Preferred stock generally guarantees a regular dividend and receives priority over common stock in the payment of dividends and distribution of assets in liquidation. Preferred stockholders' rights are dividend preferences. Number 1, dividend preferences. Number 2, conversion privileges. Number 3, liquidation preferences. Number 4, call provisions, otherwise called redeemable. And number 5, denial of voting rights. Common stock has voting rights and receives all benefits not assigned to the preferred stockholders or creditors. Selling different classes of stock with different features attracts shareholders with diverse risk preferences and tax situations. Standard recorded capital stock. Both preferred and common stock are generally recorded as or at par or stated value. Any extra consideration received is recorded as additional paid-in capital. Important standard: stock warrants and options. A stock warrant is the right granted by a corporation to purchase a specified number of shares of its common stock at a stated price and within a stated time period. Corporations also grant employees and executives the right to buy stock at a set price as compensation for the services called stock options. Account for the distribution of assets to stockholders. Assets are distributed to stockholders by 1. Repurchasing their shares of stock, treasury stock. Side note, treasury stock reduces the equity. Or number 2, paying dividends. The journal entry to record stock repurchases, resale, and retirement. For repurchases, the journal entry is treasury stock is debited and cash or cost of treasury shares is credited. Resale, or the selling price is higher than the cost, is debiting cash, crediting treasury stock or cost, and crediting APIC treasury stock. Resale, when the selling price is lower than the cost, is debiting cash, debiting APIC treasury stock, debiting retained earnings, and crediting treasury stock or the cost. Journal entry for retirement. Common stock or par value is debited. Debit APIC common stock. Credit cash or the cost of treasury shares. Moving on. Typically, the corporation pays dividends with cash. Dividends reduce the retained earnings. Journal entry to record the dividend declared, recorded no JE or no journal entry, and paid. The dividend declaration specifies, number 1, the declaration date, which is the date on which a corporation announces its intention to pay a dividend on common or preferred stock. Liability, which is liability. The dollar amount of the dividend, usually stated as the number of dollars per share. The date of record, which is the date on which a stockholder must own one or more shares of stock in order to receive the dividend. There's no journal entry for that. The payment date, which is the date on which the dividend will actually be paid. Moving on. Stock dividends and stock splits, which is important, do not represent a payout to stockholders. These transactions have no effect on total stockholders' equity. Small stock dividends increase the number of outstanding shares by less than 25%. They are capitalized using the stock's market value just before the dividend. Large stock dividends increase the number of outstanding shares by 25% or more and are capitalized at par. A stock split increases the number of outstanding shares without altering the proportionate ownership of a corporation. A stock split involves a decrease in the per share par value or stated value with no capitalization of retained earnings. No entry is required to record a stock split because no account balance change. Preferred stock generally has dividend preferences such as being cumulative or participating. Calculation of current dividend, cumulative dividend, and participating dividend. The cumulative dividend preferences requires a payment of all preferred dividends, both dividends in arrears and current dividends. Before any dividends are paid to common stockholders. Describe the accounting issues. Standard. Describe the accounting issues related to retained earnings and accumulated other comprehensive income. Retained earnings represents the earnings that the corporation elects not to pay out in dividends. Ending retained earnings is calculated by adding net income and subtracting dividends to beginning retained earnings. Retained earnings can be restricted, which communicates to stockholders that this portion of retained earnings is not eligible for dividend payout. If an error resulted in a misstatement of net income, then correction may require a direct adjustment to retained earnings, called a prior period adjustment. Certain non-owner transactions are not included on the income statement. These transactions are included in the accumulated other comprehensive income account in the stockholders' equity section of the balance sheet. Standard. Analyze stockholder payout and profitability ratios using information contained in the stockholders' equity section. Stockholders are primarily interested in two things: the creation of value and the distribution of value. Analysis of the stockholders' equity section of the balance sheet is in conjugation with the statement of stockholders' equity allows stockholders to separate these concepts. Stockholder profitability ratios. The two most common ratios used to evaluate the stockholder profitability are return on common equity, which equals net income minus preferred dividends divided by average common stockholders' equity, or EPS, equals net income minus preferred dividends divided by average common shares outstanding. Stockholder payout ratios, dividend yield. Stockholders payout ratios. Dividend yield equals dividends per common share divided by common stock price. Dividend payout equals common dividends divided by net income. Total payout equals common dividends plus common stock repurchases divided by net income or comprehensive income. Stock repurchase payout equals total payout minus dividend payout. Chapter 11, cash flows. Explain the purpose of a statement of cash flows. The statement of cash flows is one of the primary financial statements whose purpose is to provide information about a company's cash receipts, inflows of cash, and cash payments, outflows of cash, during an accounting period. It's the last statement to be prepared. Standard. Identify and classify business activities that produce cash inflows and outflows. The statement of cash flows is divided into three main sections based on the fundamental business activities that a company engages in during a period. Cash flows from operating activities, which encompass the cash inflows and outflows that relate to the determination of net income, revenues, and expenses. Next one. Cash flows from investing activities, which are related to acquisitions and disposals of long-term assets and investments. And lastly, cash flows from financing activities, which are related to the external financing of the company, debt or stockholders' equity. Some business activities take place without affecting cash and are referred to as non-cash investing and financing activities. They are required to be reported in a supplementary schedule that is shown either at the bottom of a statement of cash flows or in the notes to the financial statements. I'm still here. The three cash inflows are operating activities, investing activities. Never mind, disregard this. Still here. Understand the relationship between changes in cash and the changes in the balance sheet accounts. Because of timing issues between the recognition of revenues and expenses and the inflows and outflows of cash, information about a company's cash flow can be obtained by examining the changes in the balance sheet account balances over a period. Increases in cash result from increases in liabilities, increases in stockholders' equity, and decreases in non-cash assets. Decreases in cash result from decreases in liabilities, decreases in stockholders' equity, and increases in non-cash assets. Standard. Prepare the cash flows from operating activities section of a statement of cash flows using the indirect method. The indirect method for reporting cash flows from operating activities begins with net income and adjusted for non-cash items to produce net cash flow from operating activities. The adjustments to net income are necessary to eliminate income statement items that do not affect cash and to adjust accrual basis revenues and expenses to cash receipts and cash payments. 4 types of adjustments are necessary. Add to net income. Number 1, add to net income any non-cash expenses and subtract from net income any non-cash revenues or depreciation. 2, add to net income any losses and subtract from net income any gains. Number 3, add to net income any decreases in current assets or increases in current liabilities that are related to operating activities. And number 4, subtract from net income any increases in current assets and decreases in current liabilities that are related to operating activities. Yes, this is all correct. Standard. Prepare the cash flows from the investing activities section of a statement of cash flows. The cash flows from the investing activities section reports the net cash flow related to buying and selling property, plant and equipment or other operating assets, purchasing and selling investments in other companies, and lending and collecting the principal amount of loans from borrowers. Standard. Prepare the cash flows from financing activities section of a statement of cash flows. The cash from the financing activities section report the cash flows from the financing activities section report the net cash flow related to the borrowing and repayment of the principal amount of long-term debt, the sale of common or preferred stock, the payment of dividends, and the purchase and sale of treasury stock.